Oh man, today on the show, you're in for a treat. I'm joined by Mike Fata, entrepreneur, investor, author, host of the Founder to Mentor podcast. Mike built Manitoba Harvest into the world's largest hemp food company. He exited for nine figures. Now spends his time helping founders grow and scale their own ventures. And man, we're going to dig into all of it: brand building, exits, fundraising, what it really takes to win in CPG, and you're going to hear it straight from somebody who's been there, done it, done it at the highest level. I'm excited to dig in on this. Let's go. Okay, here we go. Damn, I'm really excited. I feel like, when they say you shouldn't meet your heroes, or you shouldn't meet people that you look up to. And I don't know if that's true. I don't know if that's true in this case, Mike. So I'm here with Mike today, and I've been following Mike's story and his journey for years, I feel like, and he's been an incredible inspiration to me, and I feel like a role model for most entrepreneurs to follow. And man, I just want to be around him. I just want to grab his energy. I want to grab his knowledge as much as I can, and we get to spend a little bit of time with him here today. So Mike, thanks, man. Thanks for being here.
Yeah, no, appreciate it, man. Thanks for having me. And I think we're due for a chat. So this is perfect.
Long overdue, it feels like. Also, I need a Midday Squares hat.
Yeah.
I'm gonna need one.
Got to hang out with Jake more. I have all the gear from bunking with Jake, or going to trade shows, or going to Montreal, go to the chocolate factory for a tour, and then grab all the gear. It's getting more.
The reason I started a meat snacks company was to stay away from chocolate.
Yeah.
That was like my thing. If I knew I was going to be like a food entrepreneur, I probably would have went into the chocolate business. But I didn't know I was going to do that. I was making my own beef jerky and then trying to stay away from chocolate. But those guys do a really good job. So I'm happy to rep all their gear.
Yeah, I don't eat chocolate anymore. Like chocolate bars, it was always fun, to have dark chocolate. But in the last 4 years, since being involved in MDS, I just have MDS because it's satiating. It gives me all of that, but it doesn't make me feel like I've cracked out on sugar.
So yeah, no.
Grams.
Smart, really smart, really smart. Well, it's my go-to. I grab it at the local Sprouts that I'm lucky. I have a Publix, Kroger, Sprouts, and Whole Foods all within like 2 miles of where I live. So I get to just make the rotation. I'm always doing store checks and things. I typically grab the MDS at Sprouts.
Nice.
Yeah. Well, look, this season series, I don't know what I'm calling it yet, has really been centered around the fundraising process. And I haven't been on both sides of the table, but I've been on the other side, the entrepreneur side, where I've had to go pitch, whether that be to angel investors, to venture capitalists, private equity firms. Heck, I've been in a few strategic discussions. And so I know what that's like, and I know enough to be dangerous. But I thought for this season, I would talk to people who know what the other side of the table looks like, and could help guide people like me, people that are not as far along as me, maybe people that are further along than me, through this process, and try to make it a little easier for them. So your journey is unique, I think, in how you got to where you are. And so I'm really, really interested to learn about that. So before we get too far, can you just give us the 30,000 foot view of where you started, and then kind of how you ended up in the seat that you're in today?
Yeah. Yeah, I got interested in health after weighing 300 pounds and changing my lifestyle when I was 18 and losing 100 pounds. And I got super passionate about all things health, which led me to hemp and hemp seed foods. We started Manitoba Harvest in 1998, and then over 20 years grew that to $100 million in revenue. And then we sold it 6 years ago now. So I guess my claim to fame is like agriculture, manufacturing, consumer brand into 16,000 retail stores, all the way up to a 9-figure revenue, and then exit. And then in the last 6 years, I'm not operating a business. I'm helping other entrepreneurs do the same thing, basically, and get in at like the venture stage, $5 or $10 million in revenue, and help them grow it to 50 or 100 by investing in them, advising them, and helping out. And so I have 7 companies in my portfolio now. Already had an exit with one of the portfolio companies. We sold Cuisine. We went full life cycle, and then have had 2 bankruptcies. So and then as well, I wrote a book and I do some coaching and I do some public speaking. But that's kind of all of those things together over the last 6 years have set the stage for the second part of my career after operating.
You know, your journey is probably, well, I don't know if there's an actual typical journey, but I think what everyone chases is this like 5 year sprint. It's like, oh, can we go from 0 to 100 million bucks in 5 years and like chase this big exit? I think yours is more of like what a standard, like, let's start a business from nothing and then let's build something durable over time and incrementally get better every year. And then, I mean, you spent 2 decades in it.
Yeah.
Um,
That's what I tell people, because the reality is if you look at the amount of companies that do that have like a 5 or even, less than 10-year full life cycle, it happens, but it happens at the frequency of people winning lottery tickets. It's like 1 in 100,000, 1 in a million, 1 in a couple million. So entrepreneurs have more to risk than gain by swinging for the fence like that. And quite the opposite is true. And that's what I've learned. Like if you get into a business and you start a little engine that could, and you get better and better and refined and keep at it, you can amass a big business and you can be very capital efficient doing it, and you can be really like a low risk. That's not to
yeah,
say that it's not a big grind up front, but like that approach works. And a lot of the entrepreneurs that I know that were wildly successful, like had the big, 9-figure exits, more of them are the 20-year overnight success than that like 5 years or like 7, 8 years,
yeah. I remember when I met Justin Gold for the first
yeah,
time, maybe, gosh, it's probably been 10 years now. I met him at a trade show and I thought they were like that's what you got to go shoot for, but they weren't that big even that back then. And again, he was kind of a very similar, almost 20-year journey from, farmer's market to exit. But I think you're right. The other thing is I spoke with, last year I was having a conversation. I got introduced to A-Rod, former
yeah,
baseball player turned
yeah, yeah.
entrepreneur A-Rod. And I've had a handful of conversations with him, but A-Rod would leave me with advice like this. He would say, Jason, make sure you're building for the next 30 years. Even if you exit in 3, he's like, build for the next 30. Um, and I think that's really sound advice.
For sure. Yeah. That's what I tell people. Like it's a turnoff to me if when entrepreneurs come and they're looking for investment, and they're saying like, "Hey, we're going to do this for the next 4 years. We're going to build it to this revenue, then we're going to sell it." It's actually a turn off. And not to say that you shouldn't have a good exit strategy, but the reality is, if you just grow a good business, like a world class company, you're going to have the exit opportunities. So I really love the entrepreneurs to say, "Hey, we could do this forever." We're probably not going to do it forever. We're going to try to build it to like, 8 figures, 9 figures and find an exit, but like we could do this forever. Those are the ones that usually have a bigger chance of success, instead of like forcing a timeline.
Yeah. It's because those guys in those really dark moments, they know that like this too shall pass. We're just going to keep going anyway. Um, Mike, what made you want to get involved on the investor side of things? You certainly didn't have to, right? You have a big exit, you have a successful business, you can go write some books, do some maybe some mentoring, do some public speaking. But what made you want to get involved on this side of the table where you actually write physical checks into
Yeah.
people's businesses?
I mean, I've realized from an investment standpoint, I only like to invest in things that I would do myself, right? Like, and that's even like public market. I'm not a public market index fund guy. I never have been, because I shouldn't say I never have been. I was for a very short period of time after I started coming into money after we sold the business the first time, because I didn't understand. But when I got the first checks and saw like where the companies that I was invested in to make that money, I went, whoa, and so um, I decided that I'm going to be driven by brands that I want to represent because I have them in my house, and And but to more directly answer your question, why I got into investing in our space is that I'm an operator. I love growing businesses. I love growing strategy and teams and culture. I like winning. I like winning awards and new customers and international expansion and distribution, trade shows, and all those kind of things. But I don't want to operate in a business. I know after operating a business for 20 years, going full life cycle, having two facilities, having a couple hundred team members, highly stressful, and getting out of that situation, I felt like, okay, I did that part of my career. I jokingly say in those 20 years, I feel like I worked a 40-year career, right? And so then my I'm not someone to retire and sit on the beach or golf 100% of the time and do nothing. That'll drive me crazy. So the best way to be able to be involved in all those things but not operate is support good entrepreneurs, right, at the investor
Yeah.
level, and that's what got me. That's what got me into it.
Got it. So it keeps you sharp. It keeps you in the game, but not in a way that
I
you
don't
have
have
to
any.
like.
I like to say, like we can't be entrepreneurs, and this is very true in the food and beverage CPG space. But operating a business, you always have shit sandwiches to eat, right? Like it just that's it. Elon Musk says chewing glass. Whichever way you want to think about it, it's going to happen every day. The bigger the business, bigger, more of those problems, more team members, more things like that. And I don't want to do that. I want to have have a lot of other things in my life that I involve myself with, and the businesses that I'm involved with. I like to just be from afar. So if I
Yeah.
support with capital and strategy and growth, I'm generally not getting the call that something's broken and major customer just left, or supply chain
Yeah.
failed or whatever. And so yeah, less shit sandwiches to eat.
Wait, let's just dispel a myth right now. Are you telling me that the problems don't go away when you're at
Yeah,
$80 million in sales?
yeah, right, yeah, yeah. Hopefully, if you built it right, you have more of a depth of team that has experience and prepared to go. But yeah, like when it's bit, we basically grew at, the second 10 years of Mental Harvest. We grew from 10 million revenue to 100 million in 10 years. So it's basically $10 million a year that we added onto the business of growth every year,
It's big.
which um when you start to get up into 60, 70, 80 million, actually accomplishing all those sales again and then growing like another 10 million almost feels impossible every year. So everyone says like, oh yeah, you're on a roll now. Yeah, you got to protect all of that you got, and all those truckloads of business and do more. Yeah, it's more stressful.
Yeah.
Yeah. So
Got
you
it.
gotta you gotta you gotta you gotta you gotta be healthy and try to keep the body and the mind and the spirit right to be able to do that for a very long period of time, because you're gonna get those.
Oh man, you're hitting on something I wasn't even going to talk about today, but now you just opened up the box. Tell us that. So that last let's take the last 5 years even. Like what did you do to stay healthy mentally, physically, emotionally, to sort of get through? I mean, obviously certain people are just built a certain way, but man, to your point, you're at 60 or 70 million dollars in sales, and you got to protect all that business and then go add another incremental 10. That's hard. How
Yeah,
do you stay mentally
yeah.
prepared for
I
that?
think I think the biggest gift for me was my rock bottom moment, and I see this in other people as well. But like when I was 18 years old and I was 300 pounds and I was physically out of shape, mentally unwell, emotionally unstable. Like when I decided to make change in my life, and then over 2.5 years, not only lost 100 pounds but got into the wellness routine of weightlifting and doing cardio and doing meditation and breath work and yoga and all these modalities that we know just part of a healthy lifestyle. Now they're becoming more mainstream known as part of a healthy lifestyle. So I had that foundation. And when I got into business in the heavy growth years, I was focused more on, we're competing for the Olympics here this year. So I'm going to be focusing on what I call now is like focusing on being my best self so I could do my best work. And that's what I love about being in the natural products industry and about organic and natural food, is that it's a health and wellness industry. So like being the leader of a health and wellness company, I felt like, at least I felt the internal pressure to show up healthy every day, because we had a team that also, not everyone is going to be taking cold plunges and doing saunas and stuff like that, but they aspire to be, to take control of their health. And even with all of that training, it got really hard at the end, and a lot of because I would sacrifice sleep, and then I'd be out and I'd be away from home, so I'd be eating my diet not like perfect, and there would be more stress because we're trying to like pull a huge boulder up the hill and stuff. And so, I went back to the foundation. I always go back to that foundation. And any entrepreneurs that I talk to, I said, just think about it like being an athlete. You to be your best and perform at that games or that match or whatever. You got to sleep well. You got to eat well. You got to train. And that's true. It's for sure true
Yeah.
for CPG entrepreneurs.
I think it's overlooked from an entrepreneur's perspective. To your point, the travel, the grind, the lack of sleep, all those things tend to compound. And then, but we think we have to do all of that. And I think to your point, like put yourself first and ensure that you're
Yeah,
sound.
yeah, it's a hard one. It is a hard one. Like they say, when you're on an airplane, it's crashing. Like put your own oxygen mask on first before you help other people out. Like leading a company, leading your family. Like you can't you can't give everything. If you don't have it to give sustainably over and over. Little sprints, yes, okay, whatever. But the whole analogy of like make sure your teacup is full and filling over into your saucer and give away your saucer like that is a good visualization and just a good way to keep ourselves in check and balance,
Yeah.
and have health and wellness right up front and center, not an afterthought, because we know what happens with it as an afterthought. It just never gets done.
Well, that's good. And I appreciate you bringing that up. I think it's often overlooked in business. And I think it's really important to talk about. You do a really good job of that publicly, I think, generally talking about that. And I appreciate you keeping it top of mind. Let me ask you this. Because your journey, I think, is non-traditional into like the venture capital and investor world. Do you think you have other different hurdles today than maybe a guy who went and got his MBA in finance and went into the VC world and is really like just a numbers guy only? I mean, do you feel like you have different hurdles than those guys?
I've always been, again, I talk about the two things that I've found success after selling one business, and I wasn't sure I was going to be able to do it again. Right. But the things that success have given me is just be authentically myself. So over the last 6 years, what the world sees of me is like me being me without worrying about things that I worried about in the past as a leader. Like I got to show up a certain way, or think people are going to see me a certain way, or think about me a certain way. I'm showing up with a sleeveless shirt to a business meeting or whatever. Right. But so I think that giving myself like permission to fully be that unleashes my superpower. And then I'm very, like, I am a numbers guy, and I'll talk to a lot of financial investors and take them to like conversation on the spreadsheets and the return and the analysis and all that kind of stuff too. But I know my true strength is I've operated a business. Like when I talk to founders at all stages of company, I'm talking to them about the strategies that I would be thinking about right now because I'm still in the game, and I've kept my head in the game over the last like half a decade by being involved in building a portfolio of companies and mentoring thousands of entrepreneurs and like just keeping a good handle on what is market and what stages all these businesses are at and the challenges that they're having in common, and that's hugely beneficial to entrepreneurs. Financial people, besides giving money, that's where the gap usually is they don't truly understand what the founder is going through or the
Yeah.
executive team's going
Yeah, I think you're right. I think you're right. Mike, do you think I have a strong opinion in this area, and I'm just curious what you think. Like, do you think that like funds, like venture capital funds, private equity groups, do you think that they should make a concerted effort to like hire more founders or former founders and bring them
I
in?
think the strongest, well, and it depends on the stage too. For sure, it's in private equity, but you're seeing it more in venture. Um, I think the best funds have operators involved. Whether they would call it an operating partner, it's an ex CEO, ex president, ex entrepreneur that's scaled their business, and then there's the finance people, right? And the finance people for sure are putting the fund together, going and raising money with their LPs, or they're networking, they're doing that. But the operating partners are plugged in. And actually can support the CEO, support the executive team. So that's what I do. Even though it's like my family's money, I'm usually in partnership with, I work with all the food and beverage CPG VCs in Canada, and then a number of them in the US as well that I've doing business in the portfolio companies together. And to them, if I'm involved from a governance standpoint outside of my check, on the board as an advisor, like I'm helping the funds with the entrepreneurs, like so they both they're both satisfied with the relationship because they both have different expectations, right?
Sure.
And I can help bridge that gap.
Yeah. Got it. All right. I do want to ask you now some traditional like venture stuff.
Yeah, for sure.
So, like, can you talk me through how I want to talk valuation first because I
Yeah.
think it's a subject that lots of people are very
It's com-
confused about.
yeah.
Entrepreneurs always overvalue themselves. I think that they think VC shops undervalue them. I think there's no straightforward line on how to think about valuation. No one gives you a straight answer. How do you think about valuation?
It's a complex formula for sure because it depends on where market's at and what the stage of the business, right? And so um, ever changing. But I could tell you generally, like in the market condition right now, we're back into what is an investor's market. It's not a founder's market, right? There's lower amount of capital, and then there's more companies that need capital. So it's more the market's swung a little bit to an investor's market. What does that mean? Well, the valuation multiples are going to be lower, and the terms are going to be more restrictive for the pref share terms generally, and I would see a range in this market of probably 1 times to 2.5 times revenue as being a valuation for enterprise value. But again, there's a lot of factors to that, right? How fast is the company growing? How strong is their margin? How much moat do they have? Do they have a manufacturing moat or some other IP? Who's the team involved and what stage are they at? Because investors like investing in team, and then they could jump to start seeing maybe the next year's growth or a portion of that, or last quarter annualize instead of trailing 12 months. Like there's all these different ways to get at a multiple change. But I still see it in that range,
Got it.
and a lot of founders are confused because they see a business selling for 3 or 4 or 5 times revenue, then they think they're at a venture stage. They're worth that.
Yeah.
And just most investors aren't going to be, especially in this market, wouldn't be prepared to do that unless there was some crazy restrictive terms like 2x liquidation preference and participating and performance warrants and these other things that an investor has tools in their toolbox to right size evaluation, but a lot of founders don't know what they're signing up for if that's the kind of deal that gets presented.
Yeah, I want to ask you about that. But first, I want to clarify one thing. When you talk about revenue and we think about revenue multiples as it relates to enterprise value, um, for brands in like the 5 to 7 to $10 million a year range, are you speaking in net revenue terms or gross revenue?
Always net revenue.
Yeah.
So, I've learned that. So when the first time that we sold Manitoba Harvest in 2015 to private equity, that was a major financing transaction that I learned a lot because we hired an investment banker to run a process. We ran a full auction. Like you get a really good understanding of where market's at that time, right?
Yeah.
Yeah, if you go to if you think about it at that level and how the big food and beverage CPG companies are to the market, and it trickles down, right? And so yeah, off of net sales, and then gross margin's got to be a proper gross margin structure because there is a formalized one that's gap and standard for the industry. But not all entrepreneurs look like that. People talk about, it's actually one of my pet peeves as an investor, just because it lacks clarity. So I tell people, anyone that's listening to this, trust me on this one. When you talk about your revenue of your company, be proud to say what the net revenue of your company is right now for the last year. And if you're rapidly growing, say what it was for the last quarter annualized. It also gives perspective. What you probably shouldn't do is give gross sales, give lifetime sales, give retail dollar sales, which, hey, those are all measurements of how you're selling, but it's very confusing. And what an investor expects to hear is net revenue over the last 12 months, unless you have any kind of clarification points. And you'll see founders out there like $50 million in sales over the last 10 years that we've been in business, but we're really doing 9 million a year in net revenue. Okay, we'll be proud of the $9 million
Yeah.
a year in net revenue. It's very clear. And if someone's valuing your business, what off the current multiples, maybe you're worth 18 to 22 million if you're raising money. So it all flows
Yeah.
together. So that's that's some of my learnings that, people can, entrepreneurs, when they're putting their investment deck together and their expectation together, they can be aligned with what the market standard is.
Yeah. No, I appreciate you clarifying. I wanted to ask you that because I knew you'd have a really great answer. Um, and it's not something I was familiar with, in the early days. And it might, when I look back, when I look at this, man, September will be my 13th year doing
Mm,
this full time. So, I've been
nice.
doing it long
Congratulations.
enough to be dangerous or know enough to be dangerous. But I remember those early days. I mean, I didn't even know the difference between gross and net revenue was. So, but I think it's important that you speak right in terms that people have um, an expectation for. And I've even been like, people have even called me and asked me for help, and I'm like, well, tell me where you are, and they give me that same type of answer. Oh, we're at 50 million in sales in the last 12 years, and I'm like, well, that
It
doesn't
doesn't
help
help,
me.
right? Same thing with gross margin, right? Right underneath that. If you say growth margin, people love saying, because they hear it's good to say, like, we have better than 40, we almost have a 50 gross margin. But a lot of times they're like, well, they don't have operational costs into their margin. They have it below the line. Like there's a
Mm,
standard for that not everyone follows. And that's why we try to educate people on that, saying like, hey, I have a template that we've gone through a full quality of earnings report by the big five accounting firms to do $100 million transaction or whatever. Like there's if you follow that standard, you'll not be second guessing yourself to the
yeah.
market, anyone that's reading your materials.
Yeah. Yeah. No, that's good, man. That's really good insight, and I appreciate you sharing it. And I appreciate you actually being a little more specific about valuation. Even I think that a lot of people are hesitant to even talk. Like, no one ever gives me straight answers. We all talk about it behind the scenes. Everyone says that, but whenever I ask people, they really have
Well,
a hard
and
time.
I find that helpful, Jason, so that people can, like founders, can think about what their pro forma cap table could look like through different stages of business. Again, I have that after 20 years of going through full life cycle selling the business and now being involved on the other side of it, but I didn't see that earlier on. Thankfully, it worked out well for me, because we had good investors from when we started investing institutional. We had our institutional capital. Plus, we were really capital efficient. Plus, it was a 9-figure revenue, so the multiple really helped for me personally as a founder. But I've seen too many founders get offside. They have a great product, they have a great business, but they didn't engineer their cap table right because they didn't think through. Okay, we're going to raise $500,000 now to get us from 3 million to 5 or 10, and like how that's going to
Yeah.
stage up. So being clear with people and then educating them, and then giving them a tool or template to work through that. Not everyone likes what they see when they go through it, because you still got to be. Not every business is investable. It's
Yeah.
just not.
It's fair. It's fair. It's a good point. I wish I had that template. To when I look back, it's like I could have engineered this differently, but fortunately for some of us, it might work out. But to have that, you could really get ahead of some of those things. You mentioned some levers that the investors have in their pocket, particularly in an investor friendly market.
Mhm.
And I don't want to get too far into the weeds with this stuff because it does confuse some people, but there's a few things that I think are interesting there that people should watch out for.
Yeah,
And I don't want to say that like any of it's bad, right? Sometimes it's just representative of the market. But
for
when
sure.
entrepreneurs sometimes get caught up in valuation multiple,
Yeah.
and then they
Yeah, they just get
miss,
fixated on. Listen, here's my own personal journey. I speak from experience. Um, Business was growing quickly. We got to a place. We did a couple friends and family rounds, were common shares. Okay, everyone's on the same page. But when we got to an institutional round and we got to pref shares, I didn't know a lot about it, but we were going through the process. I had an advisor, thankfully, but I didn't know a lot about it. And then I was like, well, we're doing, at that time we were doing $10 million in business, $8 million in business, and it was an investor market back in 2008, 2009 because of the financial crisis, and so valuations weren't that, the multiples weren't that strong. But I learned it's not just all about valuation, because as soon as you step out of common share into preferred share, those preferred shares can have all these different rights to them, and those all, in the simplest form for your listeners, those all have a cost to it. That's the best way to think about it. And so, what's the true cost of the valuation that you're getting? And it's good to understand that. It's good to have an advisor, legal counsel, talk to other founders that have gone through venture, like raises like that, to get a good understanding of it, because it's not just, it's not nothing. Those parts, those legal parts of the contract are going to set you up to say, are you going to make any money as a founder 10 years from now, even if you do 5x this business with this capital? How much, and how many other restrictions are there? And so, yeah.
What
The
what would you
normal
say?
ones, yeah,
Go ahead.
yeah,
Go
the
ahead.
normal ones like an accruing dividend is a normal. A liquidation preference, which gets a lot of people because there's non-participating liquidation preference and participating. But that just means that those preferred shareholders get their money out first, and sometimes a multiple of their money out first before any common shareholders do. And those are the two big ones. And then after that, it's usually governance items like a board seat, a voting rights agreement, so that these investors control more than the board even does, and understanding those parts of the agreement. The cool thing is, I said get advice, right? The cool thing is you could run a term sheet that you get from an investor through Chat GPT or one of the other AIs and ask it, like to give you points on it, and you get some feedback that way. If you were just sitting in by yourself and kind of going through it without an advisor.
Well, you could even do that as a first step and get your mind right before you go to the advisor so you can zero in,
Yeah,
right? With the lawyer, you could ask him very specific questions instead of just like, hey, read this document and tell me
yeah,
what I
and
should know.
that's what I got to beforehand. We call it like financial engineering, but the cap table financial engineering. When you're going and raising money, if you know, okay, we're $1 million company now, so our business is probably worth like $2 million. We're going to raise $250,000 to execute our growth plan over the next years. Okay, that means we're going to sell like 10% of the business, and then if we do grow to a $5 million company with that capital, here's what the business is worth, and like you can actually go out and either two things: get um, do an auction and get pitches from the market of what people say your business is worth, and you probably should do that. But you can also think like, hey, I know enough about market to go out there and know what a good deal looks like, for our company. And that's what I hope more entrepreneurs get to through mentorship, through advice, through listening to podcasts like this, like understand the terms. Don't go into it totally blind.
Yeah, really, really good advice. Some of the best I've received, honestly, on this podcast. Even, Mike, do you recommend people use when you're talking about cap table management and modeling and things like that? Do you at what point do you recommend people like use a software like a Carta or something like that in order to kind of try to keep track of that?
Yeah, we went to it in a number of the portfolio companies a little bit later stage. You find sometimes now like investors would prefer it because the more of their portfolio companies that are on Carta or program, then they have it all in one place. I don't think it like I until we never went through that in Manitoba Harvest, and that tech wasn't necessarily as readily available. But as long as you have a good Excel document that shows I always think current state and future state for any document. Current state
Yeah,
Excel document that shows all your shareholders and even your option holders and your whole cap table. Listen, I give that away for free. I have all my tools and templates at fatafleischman.org, which is our mass mentorship site. So you can go on there and get a cap table template, and then you have your current state, and then you should always do a pro forma. Like, hey, if we're going to raise $2 million, here's what that looks like on a pro forma cap table, and that's plenty to keep good organization of
yeah.
of your of your shareholders and your full capitalization.
So you don't have to get overly um, fancy
It's not,
with
yeah,
it.
it's not a value add again, unless some institutional firm said, hey, if it's serious to the investor, they'll put it as part of the term sheet. We're going to invest $2 million, but you have to go into like a cap table management. Probably not. More investors are worried about at that stage are worried that your financials go from like a review engagement to an audit or something, more
Yeah.
so than your cap table, automating your cap table.
Yep. 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 So as in your in the investing that you do, what are your primary goals when you're investing? Like, are there certain returns that you're aiming for? Are there certain timelines that drive that? What drives the goals that you have as an investor?
Yeah, well, I keep refining this, but the thesis for my investment is products that I have in my house that I enjoy and I love, and then founders that I meet and I really like, and I literally have over at my house to hang out with, strategize with, like we're going to hang out together. Those two are the gates. If they pass those two gates, then it's really about where is this business at in its life cycle. I like the venture stage, which is probably 5 million in revenue, maybe 10 million. that Series A kind of investment, and I'm bullish on manufacturing and strong gross margins, and I like a mixture like omni-channel business for the brand distribution. But those are all like really like that's just the business has to be a good business, but the most important part is the people and the product. And what I've learned, because then I want to be involved in the business as from a governance standpoint and advisory. I'm not a good private shareholder. And so I made 3 private investments in my fund of products that I liked and people and founders that I met and I liked. But I didn't have an advisory or governance deal with the business as part of the investment. And 2 of those 3 went bankrupt so far. And it really hurts.
Mm,
It sucks. I'm open about it because it just changed the way I view things. I don't know if I was involved in those businesses, if they would be any smarter, better still here, but I can't find out. So it drives me nuts. So
mm,
now it's like, I want to be able to find a business that's at the venture stage of growth and help that business through the whole life cycle until one day they find a liquidity, which normally is about 5 to 8 years from venture stage. Like my first portfolio company, Soul Cuisine, we did the full life cycle in under 4 years. That's really fast. Just part of it was because of market timing, but I'm looking for and I'm looking, and what's what I offer to the founders. I'm going to help you grow from 5 or 10 million to 50 or 100, and then go all the way through to a potential liquidity event.
in those scenarios, are you thinking like in the liquidity event? Are you thinking you'll ride with them all the way through to maybe some potential very large exit to a strategic partner, or does that also include maybe a larger private equity group coming in and maybe
Either
cleaning up the
way, you
cap
could
table?
sell. Yeah, like having gone through, I've sold to private equity. I've sold to strategic. We took Soul Cuisine public, so I have taken the company public experience. We sold the public company then to a private company, and so ideally is selling to a strategic because the strategic multiple is going to be a lot higher. Private equity dollars generally have to build in some return for them of doing work, and it's maybe, I don't want to say it's a second tier, but if you could sell your CPG business to a strategic, you're just going to get better value
Got
basically.
it.
Is kind of the way
So
I've seen it, and I do see it.
I heard you say 5 to 7 ish years with some probably with a little bit of flexibility in there depending on circumstances. Is there a specific return that you aim for?
I don't really think about it like that. Like I know that anything I'm involved in personally growing is going to return far greater than the market. When our investment at Manitoba Harvest that we returned to the investors was 20-fold. So they got a 20-fold return on their investment. Oh, and they were invested for somewhere between uh 10 years and 13 years. So a long investment, but they were angel investors, most of those,
Yeah.
right? Our venture capital firm was involved for 6 years and got a good return on their dollars too. But like that's kind of return. So for me, like I want to, if I'm involved with the business, I want to 10x my money is the right return for me with involvement. And again, yeah, I could take upwards of 10 years. So if you look at like 10 years to get 10x, that's probably I don't know, the compounded annual growth rate's going to be in the like 30% or something.
Yeah.
But I
Still
don't
going to
know. I don't overly fixate on the percent. I just know that I don't want a controlling interest in the company. I can have a small stake in a business at the right stage. And obviously I do like to participate in pref shares because I'm protected. Then I'm not a good angel investor because I've learned that especially in CPG, you have to go through all those life cycles, and sometimes the angel investors or the common shareholders can get stepped on later on or less
Yeah.
protected. So
Yeah.
I just choose to go at that stage because I'm also then usually helping the senior leadership team or the CEO build his senior leadership team, his or her senior leadership team, and the board of directors and like the governance controls for that stage of business too.
Yeah. Yeah. No, really, really, really smart. Um, just for the listeners out there that don't know, when you talk about taking preferred shares as a protection mechanism, what does that mean?
The biggest one, and I'm not super. I've done, like if I think about when we raised venture capital at Manitoba Harvest, besides the valuation, there was a 6% dividend that accrued for 6 years. There was a liquidation preference of 1x, non-participating, and then there were some voting controls. So I'm used to at minimum a pref share at minimum. If it has a 1x liquidation preference, non-participating, will mean that the investor's money will come out first if something happens to the business, right? It goes bankrupt or so you're somewhat protected. You have some downside protection there, and then those other controls. Like I am a governance freak. Like I've done, besides growing our business, I've been involved in board work over the last 25 years, nonprofit board work, like 6 different nonprofits for 3 or 6 years each. Now I've been on 8 portfolio company boards, and so having a strategic plan, having a board of directors, and all that governance together is really, I know that's a critical part of growing good business. It's how I feel comfortable, and that's usually that's what happens on a Series A. It usually triggers more of a institutionalizing of a company and putting in those proper controls.
Yep. Yep. Grows them up too. Yep. Understood. Thank you for that. Okay. I've got two other advice questions for you and we'll close it out. One is what makes a pitch deck stand out to you?
I like it to be simple, right? Like, I think telling an easy story is the best way, and keeping it simple. Like a nice summary page right up front, executive summary that usually is form, that says like, here's what the business is, here's what makes us special, here's what we're raising capital for, here's the valuation, here's the team involved, and then get into a problem statement, why we exist, about our products, about our team, about our distribution. That's only like, it could be 8 or 10 slides, but cover all that information. It's really simple. You can look through it and go, oh yeah, these these guys or gals know what they're
Yeah.
doing, right? And that's what makes me more comfortable. I see it go wrong with very long pitch decks that hey, if you're a venture stage company, if you're doing like $5 million or something, like it doesn't have to be that, and you're not selling your business. When we went and sold the Manitoba Harvest both times, like when we did an auction and sold Manitoba Harvest, like, or we took company public, obviously you have like 100-page pitch deck, but you don't really need that. I think it works against you for investors that are, that deck should just be, hey, I'm super interested, I want to know more about the company.
Yeah.
And
Kind of get enough interest to want to dig in further. But what I heard was give me the overview on the first page, the executive summary. Here's who we are. Here's how much revenue we do. Here are our gross margins, what makes us special, the team. And then you
yeah,
can flip through and maybe dig in a little bit deeper as you go.
yeah,
But
and
right up front.
use the proceeds for the raise. And yeah, I have my investment presentation template on fatafleischman.org. People can go there and download it, and different stages of the company that we grew it. So, but generally, keep it more simple and to the point. Just make sure you cover all the facts, right? And then you're right. What you want is like, hey, we're interested. Now we want a meeting, or hey, we're interested. Give us access to your data room, like that next stage of development. And it's something too. And it just made me think like, the biggest lesson for me, Jason, when I paid $5 million to an investment banker to sell our company, was understanding what a good investment banking process looks like. But you can't hire an investment banker probably unless you're raising $10 million of capital or more, right? You're just not going to be
Yeah.
afford their $500,000 or $1 million of fees or more. But
Yep.
you could think about running your process as a CEO like an investment banker would, meaning you have a good pitch deck, and it touches on all the points that market would want. You run a process of like, hey, put all these teaser decks out for 2 weeks and then share your presentation for a week, and then get interest for 2 weeks. Like, run it like a process, because we all have businesses to run. It's really, really complicated when you're raising capital. Like, those are the things that I've learned, is like, turn it into a 12-week process that's kind of defined over the weeks, so that you can eat that elephant at the same time you're leading your team to keep the business going. And that's why some safe mechanisms have become more common as a tool in our industry because it's a really simplified approach. I don't like it as an investor because you don't have the protections and as you would a shareholders agreement or share
Sure.
purchase agreement, but it works, right? It comes from the tech industry. It makes it really simple. But whether you're using a safe or you're doing a traditional raise, a priced raise, think about it in the kind of weeks in a schedule like you would when you're budgeting for your business, and then run that playbook.
You said something really important, because this is a mistake I made, and I think I ran a process with a investment banker, that went really well, in a private equity raise. And what I learned in that process was something you just outlined, and I want to hit on it again. I want to double down here. So what happens in most cases for people who are green and haven't done this before, or maybe they've done it with friends and family, but they haven't run, is, you put together this big long pitch deck. There's a lot of sizzle. There's very little stake. And then you go out, and maybe you don't know exactly how much you're raising, or you don't know exactly where you're going to spend it, whatever. But then, like, there's no deadline. There's no organized process. There's this, like, hey, we're going to raise $3 million and we'd like to do it by, the end of the year or whatever. And that never, like, inspires anything to happen. And so this whole point of, like, hey, you know, for the next 2 weeks, we're letting you review the deck. And then after that, who's moving to the next stage?
Yeah,
And
that's
then
how
we'll
it is.
let
If
you.
you look at, yeah, follow an investment, and people that don't know, again, love AI. I just did this the other day because someone asked me about a investment banking process. So I asked you to just define a full investment banking process with the week by week calendar. Boom, it'll
Okay.
spit it out. Like, make your deck, go out, send your teasers out, send your deck out, do a management call, get interest, week by week, and you stick to that schedule. You're right. Like, hey, if an investor, yeah, we're raising money. How you doing so far? When's the target? When's the close? There's no tension. And so you'll get passed by more than you will get when you have tension in a deal. People will want to come in, and you're gonna drive that. But at the same time, again, you're already distracted from running your business. Have the least amount of distractions by having the most solid plan.
So good. So good. That advice is so effing good. Okay. Um, I could stay on that for a while, but I'm not. So what would you say then? You mentioned that, you tend to do more deals with people that you just like. So you've gotten to know them before they're putting a pitch deck in your hands, typically, or you've built a relationship ahead of time. How
Yeah.
important is that, would you say, for an
Well, it's
entrepreneur?
important for investors in total. I think I'm a special breed as an ex-operator. Like, when people say, "Hey, I have this great investment opportunity I want to show you," I'm not saying it's a red flag, but that's not the way. I like the treasure hunt mentality, which is like, I meet founders at a trade show that I like the products in my house. And I'm like, oh my God, you're awesome. Let's go out. And then we go for dinner, and then we're networking or whatever. And then I'm like, hey, if you need anything from me, like, let me know. Like, when I use the example of Midday Squares, and Bloom never asked me, Nuts for Cheese never asked me to invest in the business, right? Like, they were doing their thing. We connected. I was helping them out, and then one day they were like, "Hey, we're raising capital." I'm like, I'll invest in your business. I was already there, right? And so,
Yeah.
but I've seen it in for institutions, for anyone listening before they want to, like, go and network with investors, generally, before you need to raise capital. It's just smart, right? And because people will want to track the business, they will want to track the founder, especially if you're talking about an institutional investment of in the millions of dollars. Like, they're gonna want to see that
Yeah.
traction a little bit because it takes the risk off of their shoulders.
Yeah. Yeah. Really hard to raise from a cold stop, and particularly really hard to raise when when you have, like, a gun to your head. So
Yeah.
it's like, the best time to raise money is when it's not like we're running out of money tomorrow too. So
Right. Yeah, and as well, like, especially rapidly growing businesses, there's some the organization of your cap table is like, how much capital do we need right now to fund us for 12 to 24 months? Usually 18 months is probably the prime spot, because it takes 6 months to do a capital raise, or it could take several months for sure anyway. And so you want to be able to raise capital, go execute your plan, grow the business without distraction, and then when you're in your window, of knowing that you're going to need capital in like 6 months, you start the process again. But you had a good, hopefully 12 months of just being able to execute, right? Because
Yeah.
it does. I say it takes, depends on the deal, but it could take 25% of the CEO's capacity when you're doing a capital raise, and then the other parts of the team getting dragged into that, depending on what kind of process too. And that's all distraction from actually going out there and serving customers and making the business better.
100%. 100%. Mike, treasure trove today, bro. I mean, treasure trove of like real, like from the trenches, know both sides of the table. Really solid. You referenced the website a couple of times where people can find resources. Is that also where they can reach you if people want to work with you one to one, or if people want to listen to your podcast, or how can people like get a hold of you if they need to?
Yeah, I mean, I love LinkedIn, right? So I'm on LinkedIn for on the regular. Everything, all of my activities, the portfolio companies, my coaching, my book, all of that is on LinkedIn, or it's on mikefata.ca. And there's links to on either one of those to fatafleischman.org, which is my mass mentorship site where I give away all the tools and templates and stuff that Greg Fleischman and I use to grow our businesses. So best to plug in that way. And if someone wants to connect, yeah, just connect with me on LinkedIn and make a note that says you listen to the show. And
I love it.
happy to connect.
I love it. Well, I appreciate what you do. I appreciate you being so open and so generous with your time and generous with the resources that you put out. They've helped me. I know they help a lot of other entrepreneurs. And thanks for doing this today. I think this is going to help a lot of people.
Yeah, man. Well, it's the selfish, selfless stuff that I do because it makes me feel good. So, yeah, thanks for the chat.
Appreciate you, man.